A lot of investors underappreciate the importance of high quality earnings. When we look at high quality earnings, we talk about companies that have robust characteristics. So things like the earnings are consistent, there's a high percentage of recurring income, they're sustainable and transparent. A lot of the factors are inside of management's control as opposed to being outside of management's control. We're also looking for things where they operate in rationally sound sectors. So the bank's a great example. And despite all the problems the banks have, you know, that sector has high quality of earnings. There's a small number of large competitors. They act rationally. The pricing power is with the supplier as opposed to client. So all these things give you confidence in the ability to be able to maintain those earnings and predict those earnings moving forward. And that's what we talk about when we talk about high quality of earnings. At the opposite end of the spectrum would be something like the resources sector. So the resources sector are very hard to forecast because a major driver is your commodity prices. Similarly, the robustness is outside of management's control. Management has very little control over the commodity pricing, which means that they can't control their revenue and hence their NPAT. So the resources sector has a low quality of earnings. Now, it's not to say you don't invest in that sector, but it means that you've got to time it better. It's not a long duration investment, and you want a higher risk margin when you do take that on. Look, I think once you realise that quality of earnings is important, it's actually quite easy to pick up companies that do have robust quality of earnings. There's probably 3 simple steps that any investor can take to better understand that. I think the first thing is to look at over the last 5 or 10 years, have a look at what the earnings have actually done. If they've tracked up nicely, neatly and consistently, that's probably a high quality earnings business as opposed to being erratic and moving wildly. The second thing to look at is have a look at what management commentary's been through AEGMs and other presentations, and look at how their revenue and profits has actually tracked versus their forecast. If management consistently is able to predict where the revenues are going, again, that's a sign of a high quality earnings business as opposed to something that's perhaps a bit erratic. And I think the third thing that all investors can look at is look at if there's been large one-offs. If there's been large one-off expenses or abnormal write-offs, that again is probably indicative of a low quality earnings business.